Okay, next up, passive LVNs created, but then also using this for a longer term move, or not even necessarily as a longer term move, as a continuation, but not one that you get immediately. The last one we looked at in the Euro was a very quick LVN continue, LVN continue, LVN continue. With this one, what we're going to look at is the formation of the LVN, but then also the idea that this can provide you a short-term scalping opportunity if the market doesn't continue to progress, and then can also leave you with a situation where you have a base to then move onwards from. So what we're going to look at is this movement in oil. This is just simple pennant flag break type move. Now, with this, what you get is an opportunity to play the breakout. There's your sort of momentum type move. Now, you don't get multiple LVNs within this move, and you'll see them on the ladder, which is why I've purposely not put them on the chart. You see it on the ladder as it rushes towards the upside. What we're looking for ultimately is a break of this high, which comes in at 92, the next high comes in at 00, and then the next high that comes in at 10. So there are your three levels to break. You could, as a way of taking this on, try and hit into each level, and as long as the momentum increases, you can use that to go bang, 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 buy, buy, buy as we move up through those areas. Alternatively, if you've just hit it on the break, once your LVN gets formed, which is formed around here, this adds a huge amount of conviction to buying above that previous high as well. So it's not just simply a previous high, you now have low volume, which shows buyers completely rip the market through there. So this then provides you support, which lasts for a further hour before you actually get the breakout. So we're not going to watch all of this, but the point being that what you see on the ladder identifies your area to be adding onto the trade. You can couple this with a technical reference, previous high, and all of a sudden this has got so much more strength. Don't get me wrong, technically that previous high should be a good buy anyway. But once you've got that low volume, you see the way the market moves through, the momentum that it moves through with, this is what says to you, this is a really good buy now, and you've got clear structure as to how you can place your stop. Without that, it's hard to define your stop precisely on this one if you don't have that profile structure created, and the visual of it, it's the way, it's seeing the action happen that gives you so much value on a trade like this. So I'll get the ladder up, and we'll go and have a look at how exactly this plays, and you can see the volume being created. It really illustrates that explosion of buyers completely taking control, and then the continuation onwards from there. Here we go. Well, we can see position already accumulated in oil, so we've got 4 lots long here as you start to come out of the flag. What we're now looking for is the break of the recent high at 09, so not 10, I apologise, 09 up here, and then the continuation. In terms of targets, there were previous references, 15 and 30, hence the offers already placed at this point in time. So that's why we've got offers already resting just above the high on the possibility that this flag could cause a small break. Remember, this is a short-term flag that runs into a longer-term single print clear resistance. So you're looking now at the ability to add on to this once that LVN gets created. A little bit of momentum comes in there. That gives you a touch of a clue when you get that 270 lot comes in. Now watch this large order, watch what it does as well. This helps then see this momentum come in. What's important here, which we'll see in just a moment, is once the large order moves up, there we go, jumps up, hits into 51. Now, that on its own, you might not think gives you too much momentum, but what it does do is it's just jumped up 4 ticks, hit market, taken out 100 that was on the offer. Nobody's selling this back. That's a big clue. That should give you some confidence. Normally, when a large order chases up and pays up, market's typically going to roll back, and it's not. It's traded 00, it's not trading back towards 96. This is a good sign that sellers aren't really that strong. They're happy to kind of sit in the way, but they're not really willing to do too much else. And now we have above there a large order stack. This was shown to be, or the market showed it was willing to hit into it at 00. There we go, bang, bang, bang. There's your momentum. And now look, you get this pocket of low volume come in just here. So there's your low volume, 16 to 10. That defines the area that you want to buy. Now on the initial move, you would be looking at this, trying to get in 17, 18 would be your initial plan on this trade. Get in at around about 17, 18, your stop can go below 10. Now, over the course of the move, the market does come and rotate back through, a bit like a single print. And so as it rotates back through, you have to be aware that your stop needs to stay down here, around about 07, below this area of low volume. Bearing in mind that you've got that previous high at 10, the high break at 10. So this is going to be your area. Anywhere in here is a decent area to buy. Initially, you would assume that it holds onto the top of them. But as we saw when we did profile week, the reality is that LVNs will begin to be filled over time. And so you could start by buying it around 17, and this then forms the base of this move. You only get a couple of minor flicks down towards 10. So realistically, approaching this as a buy it at 16, 17, 18 with a stop down at 07 is the appropriate way to go about this. If you wait for it to come back to 10, the problem that you may well end up with there is that the market never quite comes back, doesn't get back down towards 10, and you end up left out of the trade. So that's the danger that you face in trying to take it on like this, trying to sort of get into the trade at the optimal point. If buyers completely take control, which is what they do, bearing in mind, there is 3 triple-digit orders there. You've got around about 500, 750 contracts, all gone in one, and all of these prices taken out. That's the buyers showing complete control. And as they do that, yes, it does eventually trade back through here, but the main idea and the main part of the trade is to buy it from this area. Even with these flicks down, it doesn't fill the volume in a great deal. It will fill it in to a minor degree, but not massively. And that's the area to then use as your support, play onwards for the eventual break of the top of the range. We form quite a solid range here, lots of volume builds up, and then you finally get the pop out towards the top. So that's using an LVN, seeing its creation and overlaying that to keep you in a trade or give you a second shot at getting in a trade. For those who like to scalp, this provides a base of a range for you to scalp from as well, meaning that you could actually start playing the scalping up and down the range from very, very early on. Ideally, in a directional market like this, I would not be trying to play it buy and then sell and then buy and then sell. It'd be more about buy it down here at 15, 16, 17, get out around the high, buy it again, get out, buy it again, get out, or even buy more, get some out. So you could go from, say, buying 2, sell 1, buy another 2, sell another 1, buy another 2, sell another 1. What this does is it steadily increases your overall position. Because reach sell of 1 and buy of 2, you add to your position, so by the time it breaks, not only have you taken 15 ticks 3 times in a row with a 1 lot, you've also increased your total size, and you've now got 4 or 5 or 6 ready to go. When it breaks, yes, you will have covered another 1 at the high, so you reduce your size slightly, but you've got a larger position that then goes and breaks, and you've essentially paid for that position by adding in that way. Right then, let's go and have a look at another example. And this is one that you've got replay. I want you guys to have a go at this before coming back and reviewing. So I'll show you what happens, but have a go at this first. We've just seen how you want to use these LVNs. This is one in the S&P. What you want to do here then, and this gives you a bit of context, so you don't know exactly how far this is going to go. So the challenge here as well is getting into the trade and managing this trade using the order flow. There are targets, but I'm not going to tell you whether it reaches all of them, one of them, none of them. So the idea of this trade, this is on the 15th of January 2021 from 3 o'clock. What you're aiming to do is enter in the execution zone, which is 78 3/4 to 76 1/4. That's the low and this small low here. So this is the overnight block low, and then you've got a small low formed just before the cash session. That's the idea of the break. So you're looking for a break of this low, which is also coinciding with that low there. So you're breaking out of a wider range. Target-wise then, bearing in mind this is a first move, so we're not looking at the entirety of the move, you're looking at the break move. Target-wise, you've got a few. We've got 59, the bottom of this liquidation candle. You've then got 35 and 46. Sorry, other way around. 46 up here, and then 35 down here. They're your 3 targets. As I say, I won't tell you whether it will reach all of them, go through them all, or whether it won't reach any of them. You've got to work that out from the order flow. Your objective is to get your maximum position on. I believe that you have a maximum position of 8 for the S&P, so get 8 lots on, but you have a $500 stop. Meaning that you can't just throw 8 lots on. Because 8 lots on will only give you, for a $500 stop, 8 lots will give you virtually stopped out within one handle. So you are running a risk if you just go straight for it. So the idea is to use those passive LVNs to increase your size and then maximize your P&L. So the idea to maximize is that each time you get an LVN, each time you get a piece of momentum, you add on to this. But also the challenge then is to make sure that you're getting out where the end of the move is. So be clear on where you expect the end of the move to be, or what you expect to see for the end of the move. Do that, and I'll come and show you. Do that, don't continue watching the video until you've done so, and then you'll get the solution when you watch the next part of the video. Next up, a little task for you to have a go at before moving to the next section. Using passive LBNs and the concept of momentum to execute a trade. So this is bringing together a trigger as well as a passive LBN to maximize and to add on a trade. A little challenge on an S&P trade here. The trade is on the 15th of January 2021, ESH21 on your replay. You want to play it from 3 o'clock in the afternoon until 3:12. Now the idea of this trade then is to enter in the execution zone. That's this little red box down here. That's created from this low just prior to the cash session with the view of breaking the overnight relatively poor low, as well as taking out this daily low from a few days previous. It breaks you out of this entire range. Now, in terms of target, this is where you're going to have to read the ladder. Don't have a chart up, watch your ladder to indicate when to get out of this trade. LBNs can be your clue. But in terms of target, and I won't tell you which ones it's going to reach, you have 59, the bottom of this liquidation candle, 46, the bottom of the pullback before the liquidation up, and then 35, previous high and previous low. They're your 3 targets. Now, as I say, it may reach one of them, it may reach none of them, it may go through all of them. You've got to work that out within this time period where you're going on this trade and get out of the trade. You can maximize your trade, and this is the goal. Your goal is to maximize the trade. You can use up to 8 contracts, but you only have a $500 stop. Now, when I say $500 stop, that means you cannot go $500 offside. It's not whether it's realized stop, as in you've got out for more than the $500 loss. It's whether your P&L at any point goes worse than 500 or minus 500. Maximize the trade. By getting up to 8 lots, you're going to find this very, very difficult to do straight off because of the risk in that. It's only got to turn back a handle and a quarter and you're out. So you can't just go straight in. You're going to have to add on to this. I would recommend doing it in 2, so 2, 4, 6, 8, add on to the trade and then decide from the order flow where you want to get out of the trade. Have a go at this. Don't watch any more for a moment. Have a trade of this. Do it once. I'll come back and show you the solution in a moment. So once you've done it, continue with the video and you'll get to see the solution. Okay, here's your solution then. What we're looking for is this drop. Now, for those of you who traded it, I hope you recognize that within that time, so within the first 12 minutes, we did reach 59. So you had the opportunity to get out at least at one target. Over the course of the next half an hour, we actually got all the way down and went through the 46 as well. This proved to be the low for the rest of that session. Held there. Once you pop back above 46, you then get this reversal, sort of V reverse type pattern coming in. So we're going to go and look at this part of the trade. I'll start it from 03 minutes past. The reason that I said from 3 o'clock is also to give you that element of timing, to wait for that momentum to come in, wait for that to appear, and then go for the trade. You get an early potential entry as we come through 72. There's your main execution zone, 68.5 down to 65, with your target down towards 59. So we want to watch what happens coming down into this area. Velocity increases. Once you get those LBNs left behind, you can passively enter on those, but you have to be quick with this one. I'll bring the ladder up. I've got the little order indicator down here as well, so you can see the size going in onto the trade at the same time. And we'll try and do this with a finger and not make too much of a mess of it. But here we go. Trading 74. Your eyes are still going to be down here. You don't really want to be getting too much involved in this, but what you're looking for is consistent push. You can see order book sort of thickened up a little bit, hundreds on either side. That's all good. That's kind of what you're looking for. But you're looking down towards this 71 3/4. That's where you want to see it trade down to try and hit it into the low for this break. But still, remember, you've still got the move down to 65 as a potential. So this is kind of a nice early entry if we see this pressure down. And it has been pretty consistent, this move down. We've not seen any rotation back up. Trade into 71 3/4. You can go and have a go at trying to hit that. Don't get a fill, this is where you now need to start considering your LVNs. So are we getting any kind of LVN down here? You're starting to see a little bit of resistance, and this is falling into your execution zone. So this is ideal. So we're dropping down into this zone now. You're starting to form a little bit of low volume above, and it becomes apparent once you start putting volume in lower down. That's always the case with an LBN, that it becomes more and more obvious the more volume you do below. We're now falling onto the top of this execution zone. This is where if you've just gone piling straight in, you could run some problems as we start to tick back up slightly. But at this point in time, we're still not trading up in towards where the real low volume is at 70 and a half, 70 and a quarter, 70 and 3/4. So you're waiting now, can we get into this zone? Can we get down towards that 65? This is the area that you want now. You get a bit of pressure coming down into there. Now you'd be willing to add on again on this one. So build up to around 4 lots now. There's still the possibility that this can hold the low and we can jump up. So there's no need to necessarily rush into any more on this trade. You've got a reasonable position within the execution zone. You're waiting for this pressure to come to try and drive it through the low of this move, through that 65. So there we go, 65 trades. And again, we start to bounce back up. Not really what you want. And this is where the LBNs are so helpful. Because at this point in time, it's having a battle down there, but it's not really giving you any reason. You see the absorption going on as well. People are buying this. So you don't really want to be short there. Now we get a quick little drop. Now you start seeing some volume picking up and you can start putting your orders in, passively waiting to get filled on any kind of small pullback. And here we go again. Quick little hold, bounce back. See where we had that low volume previously? You can use that as your resistance. You can sell 62. Still be willing to sell 63 and a half as well if you can get back up there. So no reason to think that you need to be out of this one just yet. But what you're doing as well, by using these LBNs, you're maintaining your average price high up. The more time that we spend down here, the more volume we put in down here, the more obvious this LBN and the less likely we are to go trading back up into it. It's clearly showing that the market is happy down at these prices. So there's your first target, 59, and we've struggled on it. As soon as I'm seeing that, I'm thinking, right, get a bid in down there just in case it does one last test and that is the low. There's no real reason to get out of the trade, but it is giving you a chance to exit some of the position. Movement back in towards that LBN again, and it stalls. That's where you can have another go at selling. If it's gonna go off and come down, 62 and a half, 63 should hold to give you another shot down at the 59 and a half. So you've got the 8 lot on now, and it is close to the end of the move, but never put ourselves under any pressure. So you can now scale a little bit out and see what we go to from here. You could as well, straight away, put your offer back at 62 and a half to see if you can get a little bit more size on. You don't get that, and we get another quick little drop down towards 58. So you can have a go at jumping in here now. You've got this very, very clear LBN at 58 and a quarter. So that's giving us another chance to add on to the trade, back up towards 8 lots. So you've passed the first target. The great thing about this now is you can give yourself a very clear stop. You can give yourself a stop for all 8 if you want, up here at around about 59 and a half, 60, because we shouldn't really be trading back through this area. Just over the level at 59, so you perhaps go for your stops up there, giving yourself the chance to play for the next leg of the move. If this is going to be a high momentum move, you're looking for this to just go straight for it, straight down. If it won't do it, then you have to start to reassess your situation. But at this point, you can have your stop in, so you're safe on the trade. This will then bank you, dependent upon where your initial position is, maybe 8, 10 handles. Yeah, this isn't a massive trade, but it's a very clear trade, and it's using that LBN to find yourself something reasonably clear, reasonably simple. Don't want to always show sort of a move that goes 100, 200 ticks. And so now you can sit back on this trade. As long as we're not rotating back up, we're absolutely fine. We have seen that this is struggling here though. Constantly struggling when we're starting to come off. So you can then use that information to start to scale back a little bit. If we can get somewhere down towards the low again, then you'd be willing to scale out a little bit of this trade. And so there we see 2 lots have come out of the trade, scaling this down somewhat. Ideally, if we can rotate this small range down again, down towards 55, that's the way you want to be trying to get this move down to. Do we get the fill at 55? Yes, we get it. Brilliant. So you're now down to 4 lots. That's fine. And you could still be happy to play this with the view that if you get another drive down and another LBN, then you can add those orders back in. But now we've got to a situation where we've banked some, taken some of this position off, you wait and see if you get another opportunity, and you don't really get it here. It's quite a steady move down this last bit of the move, and you've not really formed too much in LBN. It's still 4s, 400, 300, 600, 700s, and it trades back quite comfortably. Trades back towards 54. So if you're playing off the previous low, you could use 54, but we've not really created that LBN. So you don't have an opportunity to re-add, and this is now an area where you have to make a decision. Was this, in your view, purely an absorption and a chance to give the trade up? Or are you going to try and hold that final 4 and allow the market to trade back up towards 58 area again, try and sell that once more and try and scalp this further? to try and extract that last kind of little bit out of this trade. That's how I'd be trying to approach this, how I'd be thinking through what's going on here. And you see a lot of the energy's come out of it. Yeah, the momentum on the first move down sustained. It was clearly directional. Now we have moved down towards 52. There was no real drive and hold down here. We sort of rotated down and then rotated back up reasonably comfortably. And now you see a lot of the energy's coming out of this. This is where I wouldn't be too inclined to actually buy anymore. But then start either passively exiting down here, or even if we get some pressure on 58, you might be willing to get out a little bit quicker as it starts to come back up, simply because we've just run out of the momentum down at these lower prices. So there you go. Quite a subtle one. I wouldn't suggest that this was the biggest or most strong directional move, but it's that subtlety that allows you to use that momentum to add on to the trade, and the LVNs then allow you to leverage this up. So I hope you did maximize that. I hope you will recognize the end of the move and were able to get out of this without giving too much back on their P&L. Be very interested, post them in the Discord group to know how people performed on this one. Right, onwards. Two, velocity increases. So far we've looked at passive LVNs getting in after the move. We looked also at a trigger trade where the momentum increases into an execution zone. What we're looking at now is what you call a velocity increase. There's three types. You get your simple vanilla velocity increase, and this is just all about personality change. You don't have an execution zone necessarily on a trade like this. You don't necessarily have any technical setup. It's often something that may come into perhaps a poor high, or from the middle of the range, out of the range. So your only real clue is any kind of subtle personality shift, any kind of change in the way the market trades as it comes up towards that level this time compared to here or here is the information you're looking for. So it's about understanding how the market's traded in the past to be able to identify how it's trading now, or even how we're currently trading. If you go from trading reasonably lethargically, very little going on, and suddenly you get this pickup in pace, more orders going through, larger volume orders going through, that can be sufficient, particularly if you've got something like a bad high, where you've got a reasonably clear understanding that if we reach this high, we will jump. So being confident that that's going to happen, you can play for this trade anyway. You only need that subtle bit of information that gives you enough to say this is worth playing for. Alternatively, and perhaps a little bit more clear on the break, equally without any kind of technical setup, and that's the key with these velocity increase ones. It's breaks of levels or breakouts where you don't have any obvious pre-entry. So this is all about the order flow saying now's the time to go for the break. Hit into the level. Don't use this as an area of support or an area of resistance. Try and play through the level. With a pressure build trade, what you have is a move that has almost zero rotation. So it will just constantly push on the low. Any kind of small, if it's a move down, any small bid up, immediately push back down on. And there's a distinct difference in the auctioning activity. Anyone who buys will buy a little bit and they might sort of stall the move down, maybe push it up slightly. Anybody who sells comes in quick, they take the bid away, they move the offer down. Bang, 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 nice and fast on the move down. And there's a very distinct difference in the kind of drive down, and you can feel the pressure when you see a trade like this. It will not let the market off the low, or it will not let it off the high. When you get that, you can then use those very small rotations to actually pre-enter. So there's not going to be a technical point where you would pre-enter, but seeing the size of the rotations, you may be able to look at this and maybe take a handle of risk on a trade because it's barely rotating more than that. By doing that, what you're doing is you're holding the market down, and once it breaks the level, then you get this kind of flush down. It's this kind of like constant weight, growing until finally the market snaps and you get this move down, it's sort of move lower. The final one's a snap and run. I'm quite a big fan of a snap and run as a way of taking a trade on where you know there's an opportunity, but it doesn't ever quite give you an entry. So this would be a move where you've got a market, you can see the breakout point, you know that you want to be in there, and it's kind of your last opportunity. You want to play the breakout, there's no way in early on, you can't find that entry point. So as we start to approach it, when you get the little snap over the level, it's only subtle, it's only small, you only need 2 or 3 ticks where the market goes to the level and it goes pop, 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 very quickly through. Creates essentially a very, very small LVN. What it's about is this little snap over the high. As soon as you see the snap, that says to you, you should pay up now, because it's this sign that buyers have come in and acted. They may not have shown a great deal of willingness or pressure in the move up here, But as soon as they come in and snap it through the level, this now changes people's perspective. It creates urgency. If you wanted to buy before the level, you now can't, and that's what brings more people in. So you can use that little snap as your indication, get in there, and then you're waiting for the move to continue onwards. It's a great way of playing your kind of final part of the move. Another common period or time that you would see this is on the break of an initial balance. So you form the initial balance, you're looking for a breakout, and then you get this snap over it. And as soon as you get the snap over the initial balance, then you can buy it to try and play your continuation. Obviously, you need the right context for that, but it's a method to play that type of trade. With all of these order flow type actions, as I've said before, look at your context. You want to get to a situation, let's say this is the initial balance here. You've seen that, you think you're in a market that has scope to go higher. Perhaps the initial balance opened here, so it's kind of open drive. You want the market to go higher, you think there's scope for it. This gives you the opportunity to get in. So you're kind of looking at it saying, right, what of these are available to let me into this trade if you don't have any kind of setup along the way? Often you don't within an initial balance. And so any of these would be enough for you to get yourself into that trade to play the break. So it's always there to enhance your understanding of a trade that you already want to take on, to give you that final, as I say, tick in the box, say, yep, now's the time to go for this. Right then, let's go and have a look. First up, at a velocity increase. This one has also got a stop hunt with it, and we'll talk about stop hunts later on. This one has got a stop hunt in it. We won't dwell on this, we'll cover stop hunts later on where we look at momentum explosions and exhaustion, so typically towards the ends of moves. In this case, this is a move to break multiple highs. This is an hourly chart, and you can see numerous touches on these highs that come in at 90 and 92. So your thought process is, when we hit this high, we're going to get a fast jump. Market's not going to hang around, we're going to jump through this high. What that means is that it's going to be very, very difficult to get yourself into this trade. If you try and buy the high, there's going to be a lot of competition to buy. So therefore, you need to look for something on the ladder that indicates now's the time to go for it. And this is very subtle. We'll see as the market trades up here, it trades extremely slowly. Very slow, it's very steady, there really isn't a great deal going on. And then you suddenly get this little change. And this is the velocity being shown by a sudden increase in the volume of orders going through. When you get that, now you've got the information that you need. Now you can have confidence to buy ahead of the level. Key here, you want to be in ahead of the level. If you wait for the level, you're probably going to miss it. If you get in ahead, of course it can go wrong, but you're leaning on that information that you've just been given, that somebody right now does want to buy this. And if they don't get all of their business done before you reach these highs, chances are you're going to hit some stops above those highs. There's going to be a lot of people who need to get out of a trade. And so therefore, you could be willing to buy it in the mid to high 80s. This gives you the early opportunity. If it doesn't break, or if it trades 92, 3, 4, 5, and straight the way back, then you accept that it hasn't broken and you get out of the trade. You maybe get a one-tick winner, a one-tick loser, a scratch. But as soon as it breaks and doesn't continue, the trade is no longer what you thought it was. It gave you enough to get there, it hasn't given you the continuation move that you expected, get out of the trade. That's as much as you're going to get, is basically what it's showing you. So, that's what we're going to look out for. What happens here that indicates now is the time to get into this trade? Let's get the ladder and we're going to have a look at how exactly this plays out. Here we are then, in the pound. We've got a position at this point anyway. So, small position at 79s. We have a stop entry at 90. I won't just talk about this in too much detail, and we'll cover this when we do stop hunts and why you want this to be a stop limit and not any other kind of stop. And what we're going to look at then is the break. Now, as you'll see, this is a very, very quiet market at this point in time. Passive orders, not doing a great deal. Market orders, not doing a great deal. Market's very, very slow. Look at how long we sit there. We traded one down and nothing happens. Do trade 33 up, so that's a little bit of a sign of a willingness to trade. But still, even in reaction to that, you don't see much shift in the passive orders. So this is showing basically a market that's happy to sit there. Somebody trades 33 and nobody really cares. It doesn't force anybody to reconsider their positions. We now start to get a bid moving up. So all the time you're thinking, right, I need to be in before we hit this 90-92 area. But at the minute, if you are in and you're seeing this type of order flow, there is nothing that makes you interested in getting any more into this trade. So it is very much a case of sitting back, we've just seen 5 trade up, and then reasonably quickly, another 20, 80, 90, 100. That's the info you want. Now you can be willing to go and hit into 84, 85. We've just seen it tick, tick, only subtle, and then it hits 100 up. Bids moved up as well. This is the time now where you can, at any sign of another buy into 84, 85, as long as it's a reasonable size clip that goes up, you can be willing to hit this. The bid's still slow, it does slow down, but you've just been shown quite a strong indication. There you go, 85 trades again. So we traded 100, then we traded an 85, then the move goes. It's very subtle, but it's that little shift in the order flow, that little shift in velocity, a little pop of volume that says now is the time to go for it. The stop gets triggered, which sucks the average price up, and the market then jumps. In terms of target on a trade like this, all you're looking for here is the initial jump. If you've got more to go for, if you've got levels towards the upside, that's fine, you can go for that. But on a velocity increase trade, through a high, through a bad high in particular, or any high, what you're looking for is that initial jump to take your profit from. This is a case that it's forced some people out, and the way to kind of think is the first bit of the move is forcing people out. If this is to keep going, you now need to find buyers who are willing to pay above these highs, having not been really that willing to buy lower down. So we need this to bring in new buyers. We leave an LBN right on those highs as well. So you've got the perfect place to buy more if you want to, or if you can get filled. Equally, if you buy more down here at 92, 93, your stop is pretty much 89 anyway, where you've got a scratch. You don't want to see it trading back through this large little bit of volume or this larger piece of volume. So you've got the perfect place to enter, but you see why I talk about the idea of not overly planning where you're going unless technically you've got more to be playing for. But if you look at this and say, right, I'm playing for that quick little pop of volume, that forcing people out, you can take that, and as soon as it jumps, scale out of the trade. After that, what comes next, you don't know. And so if you don't know what's going to come next, you can sort of step back from the trade and say, right, I'll wait for this to pull back and buy more. So you have 2 choices on a trade like this. You either get in, so let's say you buy 10, there's your level, so you're 10 long here, market jumps, you can get out of all 10 on the jump, bank your profit, and then try and buy on some kind of LVM pullback. Or, alternatively, you're expecting the jump, bank the jump, maybe reduce by 5, and then try and buy on the pullback, if you have reason to be targeting a higher price. If you don't, and if you have no reason to look for anything more than the ping through the high, there's no need to stay in, there's no need to add on to this trade. Simply jump in, jump, get out. What you can't control is how far that jump is. One day, in this example, it's around about 10 ticks. Another day, it might be 30, 40 ticks. That's the hard bit to quantify. But what you can have a good expectation of is that it will jump. And as soon as you see the jump, that's the information that says get out of this trade. I'll give you another example. We'll look at one in oil. This is one where we build volume up. And again, there's no obvious entry here. It's only the change in the order flow as we move through 70 up towards these highs at 77, just up here, that gives you the opportunity to get into the trade. Before that, there's nothing to do. This is the hard bit. This is where understanding this velocity increase helps. Because when you see this pop of velocity, this allows you in. Technically, there's nothing to help you here. We've got a small range, but that's all you've got. But you have got the breakout of the previous couple of days' highs. That's what you're after. You're after the jump. In this case, we jump and then we run onwards. But it's a very difficult one to pre-position for. So it's about seeing that velocity increase. The only way you could pre-position for this is if you can find this kind of range here, find an entry somewhere in the range. But even that, it's hard to define a stop. Arguably, from an hourly, you could say above 62, which is the bottom of this box, below 77. But you do get spiked out of this a few times. So if you've not managed to get in this execution zone, or you've been kicked out of the trade because it flicks back, then you can use that velocity increase to play it as the market moves through the high. We'll get this up, I'll illustrate exactly what I mean using similarities to that pound one that we just looked at. Right, similar to the pound, what we're looking for is some kind of shift in the way this is trading. So do have a current position on this one. Similar idea, we've got stop at the high as well. But the main goal here that we're looking for is to start to see the action changing. Start to see this velocity picking up. Now you've got an obvious reference, that 70, 130 lots sitting there. You want to see that trade through. There we go, tick, tick, ticks through. And it's that little pickup in pace. Again, as soon as you traded 70, you could be adding at that point. Between 70 and 77, we got a sudden little injection of pace. And it's only subtle. It doesn't have to be across multiple prices. It's that little nuanced move that says you can do it now. That's the bit that you can't really see normally, certainly from a chart. And it's all about just looking for that. Most people look for the momentum to be this drive, just little tick, a little bit more pace comes into this, hit, and the market runs. You don't get a great deal of opportunity to buy any kind of pullback on this one either. This very much maintains the momentum, maintains this velocity. It doesn't pull back. 300 at the high, trade straight the way into it. This is exactly what you want. Velocity is increased and sustained on this one. So even when people do come in to sell, they just try to do 300 there, snapped into it and trade through it. This is very, very strong velocity now. You've got lots and lots of buying pressure. You've got lots of volume going through. Market doesn't pull back. It's pretty relentless now. And this is what's then going to drive you on. If you've got into this trade and you've not sort of snapped your way out of it, so it jumps and you take some off, like in the pound example, if you've got into this and you're looking for more, and even if you're not, but you're seeing this type of order flow, this persistent hitting it into the highs, almost no pullback, then you can be looking at this and saying to yourself, I have no reason to get out. There is no reason at this point. It constantly is just ticking new highs. Look then at the rotations for a pullback. So if you're looking at where do you get out of this, I'll be looking at how far does this pull back. Just there, we pull back 3 ticks. That's all. So at this point, there really is no reason to get out of this trade. It's just constantly pressuring the highs and on and on and on. You see there, that move from 6, 7, 8, 9, 10, all the way to 16. Finally, you've got about a 10-tick pullback. So you can now be kind of thinking, right, my stop's going to move to around about 05, 06. Does it go for the highs again? If it does, you can stay in this further. You can maintain that position. You can keep hold of this trade. So that's what you're looking for. You're waiting for this to keep on going, waiting for this to drive on a little bit more. Again, trade 15 is not backing off at all. No reason to get out. So you can still be sitting there with your stops down here, waiting to see if we can get another leg. But this is very different to that pound one, which was velocity increase and jump. This one, velocity increase that is then completely sustained. There's no pullbacks on this. It doesn't hold up. It's just this relentless push. So there you go. You see, stop does move up to around about 11. Looking on the basis, if we do get some degree of pullback from here, you could then start to reduce some of your position. But at this point in time, it's still continuing onwards. Where the change is going to come, or what would indicate a change to you, is if the market does start to slow down. If you start seeing these orders going through a little bit less quickly, and also if they start to become more two-directional. This is the first time that we've seen a pullback that has actually remained reasonably sustained. Any of the others have been a kind of quick back and then bang, 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 straight back to the highs. This one is much more sustained and is not now allowing the market off the low. So it pulls back down, it's bouncing a little bit, but it's constantly being held. This is where if you are considering an exit, you can now start to do it. The momentum has dissipated, it has slowed down. Even if this is to go further, what you've got to take from the way it's trading at the moment is that you're not sure on the timing. Whether it goes very soon, this is a very short term sort of stall and then it goes, whether this turns into 5, 10, 15 minutes, half an hour, 2 hours, like that previous oil LVN example I gave you, we don't know. But as soon as you start to see the momentum dissipating, this is a fair reason to think, right, for the time being, at this moment, momentum is falling, we can stall, and then maybe we go again later. In fact, what you see here, it does form a small flag. The low of the pullback is around about 05, and then we do go once more for a break of highs. Moving on then from velocity increase, what we're going to look at now is pressure building. So you expect the velocity increase, but here we're looking at the pressure building before it happens. You're looking at this market that will not get off the low in this instance. Now, to give a bit of context to this trade, and as I say, it's always important, this is a trade that you want to be short. It's an S&P example where what we've had, this is a 60-minute chart showing you overnight sessions, which are the wider profiles, and then cash sessions, which are the thinner. Obviously, you can tell the difference in terms of the volume in the cash periods. So we get this breakout in the cash session late on. This is caused by a Fed decision, but what it does is it leaves value down and drives the market up late on. That's what you're seeing here. Classic caught in the hole scenario. Overnight, we do see a degree of pullback, which drops us all the way back down to just above 50 come the cash open. So we're already in a situation where we've taken some of this back, but still your main target is going to be coming down here towards 96, the top of this previous range. So there's still a fair scope to move on this trade. You've got some space. What you've got to try and do is work out how to access this, because you can't play this as a caught in the hole, selling it with a stop above the high, because that's going to give you a 50 handle stop. And also, you've only got around about a 55 handle target. So it's not a great risk reward. And also it's a very hefty cost if this does go wrong. You need to be more refined. You need to look at this and use your order flow to give you the access into this trade. So what we're going to see then is the pressure come in that allows you to play for this. It does mean that you're going to give up a few ticks, that you're not going to get in from the top, but you're not trying to do that anyway. Your job as a trader is not to be in from the top. Your job as a trader is to be in where the move is clear and where your risk can be reasonably well managed, is reasonably small. So that's what we're going to go and have a look at. To illustrate, here we go, 1 minute chart. Now, what we're looking for here, you have an opening range. So this is the first bit of trade down, trade back. So we've now established a pretty clear range between 52 and 39. So your trade now is going to be from a move from 39 to 96. That's the objective of your trade. You've got to try and get into this with as little risk as possible. Arguably, yes, you could have sold 52, and if you've done that, wonderful. But you can now add on to this if you are short. If not, you can get into the trade in here, where the pressure builds. This is the bit that you're interested in. As the market moves down the range, rather than sort of this rather choppy trade that we see mid-range previously between 47 and around about 41 that you've seen here, rather than this very choppy trade, this becomes much cleaner, much clearer push towards the downside. That's the pressure. And as that pressure comes in, this is what's going to allow the market to release and then drive lower. So that's where you want to try and get into this trade. You do then get this small snap down. So when we look at a snap and run, this does give you a similar type situation and the chance to add on just after the break of 39. Once you're in, remember this is a caught in the hole trade. You're looking for a reasonably straightforward move lower. And it's what you get. Granted, it does take its time to do it. This is around about half an hour to do the move. So it's not going to be the fastest of moves, but that's fine. It doesn't matter about the speed. Directionally, it is clear. Entry point is accurate. Stop is small. You can wait for this move to go. If you look at this on a 1 minute even, you've virtually one time frame this all the way down. So there's no reason to exit the trade anyway. Use a moving average, that keeps you in further. This is a 20 period exponential moving average. Delta supports the move down. Volume reasonably increases on the move down as well. So everything there is suggesting this is all looking good to stay in the trade. But the main part of this trade is that access, getting yourself in at a point where you've got the high chance of this working and a reasonably small stop. Let's have a look at how this plays out then. And what you're really watching for is the rotations off the low. They get less and less. And when I say low, I mean the recent push down, any bounce back from there, small rotation. It's those little pushes back that don't then turn around that is what's going to allow this to keep going. Similar to that oil we just looked at where it relentlessly drove into the high, this is what you're looking for now for your entry point. So we've just come off the highs at 52, we're starting to tick down. So at this point, we're right in the middle of this area. Not really where you want to enter a trade. There's no reason that you massively want to be short. The overall view is down, but at this point, there's not a great deal order flow wise that's getting you thinking that this should go down at this point in time. So what we're looking to try and do is watch for some kind of change in the way we're trading. One way that you're going to see this is just by watching any kind of movement down. We traded 46 and moved back about half a handle. So there we go, we traded 46 back to 47. Next, you want to see what happens when we break through 46 the next time. You can see buyers are struggling. Each time it ticked up 46 towards 46 and a half, offers come straight back and it gets pushed back down again. Trade 45 and the same happens again. It's rotating about half a handle here. So trade 43 and a half, now you're seeing very, very little bounce at all. And when we move back up and it starts to stall, this now gives you a point to have a go at selling. So you've got 44 and a half now as your kind of reference on any bounce. You see there, it trades 44 and a half, pushes down. Now we push down once more, where are we bouncing to? Around about 43. So you can now sell 43 as well. This is the pressure building up. So it gives you the chance to pre-enter this trade. Again, the further down we go, you see once more, the bounces are almost nothing. You can get maybe a handle on the sort of, it holds, flick, and then it pressures straight the way back down. But as soon as it bounces up, the selling comes straight back in. The offers begin to hold. The market will not keep on going down. Sorry, it will not keep on bouncing. That's what you're after. So you can then use those little rotations, that pressure, to keep your position. So you are building a position without the market really getting too far away from your price. But all the time, you're just watching, where does it hold? Where does it hold? Now you get the little snap down. As soon as you get that snap, you get your LVN, you can join that, using 38s as your area to sell. You could even potentially sell below that, down at 37. But because you've used that pressure to get yourself in, and you see the pressure remains, you can't get filled. And this is what causes people to continue to chase on a move like this. Because they can't get filled and they keep putting an offer in just like this, they don't get filled, don't get filled, don't get filled, then people become more eager to drive the market into the lows. And this is what perpetuates the pressure. You don't get filled, so you move your order down. You don't get filled, so you hit market. Other people now don't get filled, they move their orders down. So any bounce, you're constantly sort of dragging weight of orders down the market. Each time we bounce, it stalls and stalls and stalls and stalls on the low. That's what's creating this pressure. That's what's now allowing the market to go down. But the key bit to this was that early indication that you got when you were in the middle of the range. You're trading 46s and it will rotate maybe a handle. Even when it did sort of half a tick back, it would tick back, tick back, tick back, flick, and then it goes straight the way back down. But on any of those small rotations back up, the weight of selling is immediate. The sellers come straight back in, they start to take away anything that comes onto the bid gets sold into almost immediately again. This is the clue that you want, and it allows you to very tightly manage your risk behind those little pockets of pressure so that you're in as the break comes. Once it comes, that pressure releases. It's like opening a trapdoor and people fall through it. Snaps down, you can then use that mini pullback as an opportunity to sell some more, and then you're looking for the continued move. So at this point now, you're trading down towards 29s, we're into this zone down here. Now it just moves into this steady continuation phase. Because of the structure, there's no real reason to get out of this trade. If we take this back to the previous and look at where we are, there's very, very little reason to want to exit this anywhere other than all the way down here. Perhaps you've got a couple of little pockets of volume coming in here. Arguably, they could provide you some area of support where you've got this little pocket of low volume, which runs you between 22 and 08. But that's around about it. Well worth, and I'll put this into the exercises for you to have a go at. Well worth having a go at running this the entirety of the move. It teaches you so much about the way a market moves, the continuation of movement. And bear in mind, as the market is moving down, the only reason you have to get out is if it shows you a reason to buy, i.e., think of it another way. If you weren't in the trade, would you buy it here? As I said before, it's the absence of a reason to buy is enough to keep you in. You don't need a market to keep showing you reasons to be in. All you need is a market to not give you reasons to get out. That's the key to a trade like that. And that's how you hold on as a market rotates steadily down on these pressure-built moves. Next up then, snap and run. So this is the final of your initiative and sustained momentum type moves. As I said, this is a trade where if you've not been offered a chance to get in, it gives you your final chance. So what we get here then, this is an oil one on a chance to sweep through a range. So in playing this move, you want to try and get yourself into this somewhere to play all the way through the range. We don't get any technical reference, any reason to want to buy, but the bottom of the range comes in here, 62.92. And we have just traded marginally above that at 63. There's no other real reason to get in. We grind up, volume's quite low. Okay, delta's drifting up, but that's the only reason that you might have to get in. It doesn't give you enough. So you're left really without an option or without an opportunity. You'd be all the time thinking, right, I want to see velocity increase, I might want to see some pressure building. Any of these things will be enough to get in. All your job is to do is to get yourself in for this steady move. Again, very steady move because this is a clean move through a previous range. It's a range sweep trade. So let's go and have a little look. How do you get onto this snap move? And it's all about having that little pop of energy. It's only a small amount and you don't need much, but as soon as you get that, you know where your stop is. You can place your stop back down here. You've got a clear stop, you've got a clear target, you can play that move. But it's about just seeing that little bit of info that gives you the chance. Often it is your last chance, and so there is an element that you should be quite keen to go for this, because if you don't, you'll miss the trade. So it's your chance to kind of, it's not a FOMO trade as such, it's not a fear of missing out that gets you in, it's your last chance to do it. So let's have a little look, how exactly do you see these snap and run moves? Here we are then, starting to tick up the range. You can see that we've traded up towards 63 previously, there's a 240 lot sitting at the high. That's perhaps your only opportunity to try and play this as a hit and run trade. And so that you'd be always thinking, right, how could I get into this? How could I get into this trade? There's not a great deal going on. When I say there's not much technical, it's hard to define a stop if you buy it here at this point in time. So you'd be thinking, right, I can try and hit into that 280 lot. That's going to be one of your main thoughts here. And we don't back off from it So you could actually have an attempt at this, trying to buy 98, but boom, it's gone straight the way through it. This is where you then want to buy, just simply because you've got that little snap. That little snap there, it's only one price, but it traded the 250. You had no chance of getting this. So it works a bit like an LVN. But you need to be quick and you don't need a huge amount more information. As soon as it snaps through that large order, you've got to look at this and say, right, I'm willing to take any price, maybe over the next 10. I'm willing to take those using that little snap of volume as your reason to do so. Yes, it does mean you're not getting ideal prices, but your alternative is to not be in this trade. And when you look at it from a risk perspective as well, this gives you pretty tight risk. Your stop is just below that large order or where that large order traded. You're not always going to have a large order, but in this case, we saw it sort of sticking at 98, so you can put your stop at 96. So your stop is kind of defined. It pops the level, and as soon as it does that, you know where your stop is. So you can then say to yourself, okay, if it's jumped to 06, are you willing to take a 10-tick stop? And if so, hit it. You don't need to worry too much about the precision perfect nature of this type of trade. It's about playing the percentages of getting yourself in. If you don't get in, you've got no chance on the trade. Yes, you may have to pay a slightly higher price, but that little snap is giving you the conviction to do it. It gives you the reason for this to be an acceptable trade. So that's what you're after. Snap, buy it, and then you can let this go, let it put the move in that you're after. From there, it is a very, very steady move. Again though, 1 minute candlestick chart. If one time frame's up, you get one minor pullback, but using a moving average, again, you're able to hold on to this trade for the full sweep of the range. That's a move of 90 ticks, which does it in around about 15 minutes. So it's nice, steady movement. Just because it doesn't fly to the target doesn't mean this is a bad trade. All it means is that you've got enough energy to snap it out of the range. Now, slowly and steadily, more and more buyers come in because they cannot get on any kind of pullback. Final example of this is using a snap and run in the S&P to play a break of an overnight high. So kind of like an initial balance trade, this is one within the initial balance, but one where you've had steady sell-off into the move. Overnight, you've had a test down and reversal, and now you get the chance to play it through the overnight high, 76.5, looking then for the move up towards this target, 41.03. I'll play a bit of this up until your first exit, and what's quite good to see on this one is that first exit, which comes in just up here around about 92, 93 area. But it's the snap that can get you in on this trade as you break that overnight high. That's the bit with the snap. You have a point where you expect the break to come from. As soon as you see the snap over that, if there's no reason to get in ahead of it, use the little snap as your way of getting into the trade. Let's get this one up. Here we go then. Straight into the cash session. So this is right on the open, 3 or 4 seconds post the open. You can see where the overnight high is, so you know what the trade is that you're looking for. But it is very, very choppy. So it flicks down, flicks up, flicks down, flicks up. There's no obvious reference or obvious point to try and take this trade on. So your goal then is to try and buy it as we move through that high. At this point, you're still only into the first 30 seconds. It's always often advisable in the SP, let that first 30 seconds get out of the way, particularly if you know where you want to be in on this trade. So you see mouse moving up ready for this, and then you get that snap through the high. Again, just that little flick is all you need because you've already got the structure to play for this. You've got reason to want to be in this trade. So with that little snap up, this is what gives you the opportunity to enter. And then you see here, constant momentum up. Very, very clean, 77.5 all the way up towards 81. You get these mini pockets of volume, and you can now look to try and hold on to this one. Target, as I said before, all the way up at 03. So at this point in time, all is looking good. We've had that mini snap through the high, which is enough to get yourself in quickly. You've now got some low volume to act as support for you to keep this move going on. And you've got this very, very strong momentum. It's relentless hitting into offers here. And this is exactly what happens. You get this drive up. This has only been a minute or so into the session. We've just driven up. You are going to get a lot of people now feeling they're going to have to chase to get into this trade. And that's now what's going to force people to now start paying higher and higher and higher prices. And as it does so, you then get a little bit more settling down. Buyers become reluctant to keep on hitting into highs. And so you can always then still be looking down here where you've got that low volume down towards 81. That can be your area for a pullback. Any rollback down here is going to be your opportunity to buy once more. But on the whole, market continues to push on, the pressure remains in this, so all is looking good. And this is where you can sort of step back, let this one go. You know where your target is. What we'll see in just a moment, you can see the volume building up here. So this is the kind of two-directional battle that you're getting that forms this volume just here. Volume forming between around about 85 and 83. This is good. The more volume we start putting in up here, the less that this will back off, the more confidence you can have in this move going higher. If you are going to add on, as you just see there, you have to be aware of where this rotation is. You don't want to be, even if you've got in, so buying 85.5, looking at the way this has just pulled back, does not look like a good buy. But by looking at where it pulls back to, like we did with that pressure build and where it stalls, you can then see that really you're in a mini range between 85.5 and 83. In which case, yes, this isn't a great entry, but there's no reason to get out until you get below here. So it's a stop that perhaps you may not have really wanted, and it's just a mistimed entry to try and play the break. Sometimes you have to deal with this, and you have to look at that and say to yourself, well, I can take a loss in here, but all you're doing by doing that is banking yourself 6-7 price loss without being wrong. You're almost better to accept the 10-12 price loss and actually be wrong than take a loss without needing to be. So yes, it's not an ideal entry, but the pressure remains, the support remains there at 83. This can keep you in the trade, keep you looking for the next leg of the movement. It also offers you the chance to buy it at lower prices as well. So you could then try and buy it on any kind of pullback towards 83 as an alternative way of adding on to this trade. So we are seeing a bit more of a stabilization. The market's sort of stalling this one out a little bit at this point in time. You can then start thinking about, right, well, how's the next leg of this going to come? Is it going to be another snap? Am I going to get any other opportunity to get into this trade? Possibly an LVN continuation. So now you get through that high, 85.5, 85.75, still reasonably steady. There's no reason to add here now. We've not done enough to make you want to add. Creates a minor LVN, but still not a great deal on that one. So it is still a little bit of wait and see on this one. And you do have to accept that sometimes. Order flow is not always going to give you opportunity. The more trade though, the more volume it does here at 86, then you can start to move your bid up, look for that additional fill, look for the next leg of the movement. Now we continue onwards. It's now around about 5 minutes into this move. So we're just pushing up towards here, up towards the 89.25, a minor level along the way, but not any reason that you'd want to get out. And we've got this one little pocket of volume around about 86, 86.5. As long as you're above this, we can be confident of continuation. All of this last bit of the move is done on reasonably light volume. So it is an indication that people are becoming a little bit inclined towards chasing. You want to see this filling out a bit more, build some volume up like we saw lower down. This is what's going to allow for the next leg of the movement. And so then you shouldn't be sort of worried off by this pullback towards 87. If anything, you could be willing to pay up an extra tick, or extra handle, I should say, to get the 87, 87.5, looking still for the continuation. Bear in mind, your target's still off the page at the minute, up towards 03 and 10. So stabilization, you can now look, right, how are we going to break the next high? What way could this break that could give me a new chance to get into the trade here? So you can keep watching this, trades up towards 90. It's still not giving you any jump. It's not really putting a great deal of pressure into the high either. You see it rotates up, rotates back, rotates up, rotates back. This says to you, you don't need to be doing anything here. Hold that position, maintain your position until you get offered a different place to get into the trade. So trade 90, 91.5, again, another little pullback, and then boom, we've traded straight towards 94.5. When you get something like that, that's a prime time to reduce some of your size. This is a great indication of panic and leads us on to momentum explosions and exhaustions that we'll look at in a moment. What we've seen then is we moved up and then somebody has either had their stop triggered or has got a large amount of size they need to get rid of or get long. They've gone whack, hit it through the high. This is an indication of panic, of people just chasing to get in. Great time, short term, to exit part of your position. You can scale this back in using reference points that we've found from earlier on, back down towards this 86 area. We won't go all the way through that, but I can post this video up so you can see the entirety. You can take then an opportunity to buy again, maintain perhaps some of your position, but with that spike up, that's saying to you, you can get out of this, you can bank some of this now, because short term, this move is likely to stall, which it does for the next sort of 10 to 15 minutes before the next leg of the movement. Next up then, we're going to move on to momentum explosion and momentum exhaustion. How do moves end with momentum? So rather than just running out of steam and then getting absorbed and rolling back, so the change in the auctioning activity, what we're going to look at is further examples of similar trades to this, where you get this exhaustive move. How do you play for that? Can you play to just take advantage of that last little bit of the move? How do you interpret that as well in exiting a trade? So that's what we're going to go on to next.